some guys from Vanguard with us. So we've got Amanda on, who's our relationship manager, and Libby Newman, who works on the investment side. We've also got the guys from Enhanced, Bowen and Russell. We thought it was a good opportunity just to bring everyone together and just have a chat about asset allocation and recent performance over the last 12 months or so. In our reports Russell's been producing, we've touched on performance relative to the Morningstar benchmarks we're using. But because we're using Vanguard as an asset allocation guide, we thought bringing in the experts might provide a different view on their view of markets and where they're heading. So probably, again, some background. We chose Vanguard a couple of years ago to be the basis for our asset allocation. And the reason for that is they consistently sat in that sort of top 5%, if not top quartile, for every period. And it's only been the last 12 months where that's fallen back a bit. So we just wanted to have a chat specifically with Libby, just around some of the factors that have contributed to that. So Amanda, would you mind introducing Libby and just give everyone a bit of a background as to where she's come from and her experience?
Thanks, Jeremy. Thanks for having us here today. So I'm Amanda Hon, Relationship Manager for East Private Wealth, and I have Libby Newman here with me too. So Libby is our investment specialist in the strategy and research area, and she's come from a long background at a major research house called Lonsec. So Libby was at Lonsec for over 10 years, and in her last role, she was the head of equities and fixed income research. So I think, Jeremy, you have some questions around our strategic asset allocation that Libby will provide more information on.
Yeah, thanks, Amanda. So Libby, really just the big question is just that last 12 months, and you guys report, relative to peers regularly. And that was, again, like I said, a big part of why we looked at you guys for the basis of the asset allocation. Can you just give last 12 months, can you just give us a bit of an idea as to the factors that have affected performance over that period?
Yeah, great. So just stepping back, one of the things that I did in a previous life was review diversified funds. So come with a bit of a broader perspective on that. One of the key differences, I guess, between Vanguard and some of the funds we see in the peer group, or the asset allocation we see in the peer group, is the allocation that we have to bonds relative to the rest of the market, who probably had a higher allocation to property securities, or REITs as they're known, infrastructure securities, and also credit. And so that and one of the reasons we do that is because we're looking at these funds from a long-term perspective, and we want to maintain their diversification benefits. And bonds while they mightn't seem very exciting from a day-to-day perspective, are quite an important ballast during equity market drawdowns. So the slides that I've shared here hopefully now show that bonds tend to zig when everything else is zagging. So this shows some of the worst bear markets that we've seen in Aussie equity markets. And on the left-hand side, and you can see that equity markets tend to be correlated at the same time. So equities, emerging market equities, property securities and global equities are having down markets at the same time. And what we see on the right-hand side is that commensurately bonds, so Aussie bonds and global bonds particularly, sort of tend to hold their own and even sort of go up in value during those times as well. So that's sort of provides some context to why we're holding bonds in the portfolio. What we saw, and it's probably even better to take a step back even further than just have a look at the last year, and have a look at the last couple of years, because obviously we've been through a period of extraordinary volatility in the March period of 2020. And if you have a look at what has happened to, I guess, what are termed those bond proxies, so the property securities, the credit and the infrastructure, they suffered fairly marked drawdowns during 2020. In 2021, what we've seen is that bonds have not had a fantastic year in 2021. But if you look at this chart here, you can see that the bond proxies have had much larger drawdowns in the order of 10 times as bad as the orange and sort of mustardy coloured line there, which depicts what's happened in bonds. So, you know, in terms of having an asset that's quite volatile, that sort of provides some perspective on what's gone on there. So if we zoom in a bit closer and have a look at the recent performance, what we've seen since April 2020 is that bonds have really sort of just bubbled along, and that's sort of what you'd expect. Like, bonds is a relatively boring and benign asset class. It's sort of like an insurance policy in your overall portfolio. And so what we've seen is that bonds have sort of just ticked along relatively steadily, whereas what we've seen in the REITs and the infrastructure is that they've rebounded quite strongly. So that has been driving, I guess, the peers who'd held that. Obviously, if you look at that period up to March or even the middle of last year, that meant that those particular peers had drawn down quite deeply. So this, I guess, this characterises that in a nutshell. We look at that year leading from March 19 through into March 2020. There was that drawdown period. You can see the red line, which depicts the Vanguard asset allocation, held up, but did have a drop because there is exposure to equities there, but held up reasonably well, particularly relative to some of the peers that are depicted in those grey lines. And what you've seen coming out the other side is that they've had that strong rebound that we see in this slide here, which has come through in their very recent performance numbers. But if you look at it from a longer term perspective, you're actually still ahead by using the Vanguard asset allocation. So it's pretty important just to, you know, not just to zone in on that, I guess, what's in that red circle, which shows, oh yeah, that's had a great couple of months or a great 6 or 12 months for that particular asset class, because that's really a very small part of the story. So, yeah.
And I'll just add too, to put some context, we're you know, everyone's experienced some fantastic returns for the last 12 months. We're only really talking about performance relative to other alternatives, and I think that's the key, isn't it? It's just asset class differences and differences in return over a very short period of time. But like to highlight longer term, the smoother returns is what we're after for clients. And in theory, well, you might touch on it. Hopefully we'll see that come back the other way in the next slide. So thanks for that.
Yep. Cool.
Yeah, no, it's always an interesting exercise to look at these brief windows of time, even though our investment journey is measured over 5 to 10 years. You know, we're looking at a period of 6 to 12 months. So it's important to keep that in context, but it's good to go through this process when we have these periods of relative underperformance and just to understand why, and you know, we can all improve. Yeah, so it's been a fascinating journey for us and for Bowen, who's done some significant attribution work, which our clients have seen in their most recent quarterly report. And noting that, you know, we have been underexposed to infrastructure and REITs. I guess a question leading into that is, does Vanguard see an opportunity to sort of adjust? You know, the asset allocation hasn't really changed since 2016, and there's a lot of reasons for that, from transaction costs to tax effectiveness of portfolios, turnover, et cetera, et cetera. So noting all that and noting what you've just said, Libby, it's probably answered to the question already, but does Vanguard see an opportunity to adjust the asset allocation to add more to sort of REITs and infrastructure assets when you see an opportunity to do so, or is there a larger thing at play here?
Yeah, so yeah, really good question. I guess when we're thinking about introducing asset classes or allocating to asset classes, we tend to have a look at the whole portfolio. And I guess, you know, we don't see anything, going back to the question on REITs, we don't see anything particularly wrong with REITs as a sector, but I'd note we do have an allocation to REITs. You know, on a look-through basis, if you've got an allocation to Australian shares, a component of Australian shares also includes REITs. So in effect, what we don't have is an overweight to REITs. We do have exposure to REITs through that Australian shares generic exposure. And also the other thing we've got to think of outside of that is that a lot of Australians hold property outside of these these portfolios as well. So, you know, most people I know are probably relatively overweight property in terms of just looking at their personal balance sheets. And I guess for the reasons that I've already covered off on, we don't really think it has any particular defensive characteristics, and that's what we're really looking for when we're constructing portfolios. We don't pretend that we've got the crystal ball and going to know what's going to happen tomorrow in markets in the short term, as they tend to be extremely volatile. But I'd note that over a 6-month period, we started to look. The numbers are starting to improve, and in terms of the relative numbers, so that's encouraging as well.
Cool. So moving on from that REITs and infrastructure discussion, we noted a lot in our report about the unhedged versus hedged components of our international equity portfolio, and that sort of allocation to unhedged versus hedged international shares. So do you guys have any thoughts on where the Australian dollar is heading in the next 6 to 12 months, or can you give us some information around that?
Yeah, again, that's something that we, that's an extraordinarily volatile sort of prediction to make. So we don't pretend that we've got any particular insights on currency volatility. I guess, stepping back a little bit again, in my previous life, there's a couple of approaches that I observed. And I guess you can either have a 50-50 approach, or you can be active at the extremes, or you can be fully hedged or fully unhedged. And I guess the approach that we've taken at Vanguard is that over a longer term horizon, we've found there's not a huge amount of difference between the historical returns of hedged and unhedged. And it boils down to the ratio of how volatile the Aussie dollar is as a currency versus that asset class. And we found that there's not any particular characteristics that serve to predict that terribly well. So I guess we use it as a mitigation measure to try and sort of narrow in that spectrum of returns that we can get. I mean, the whole reason we're in global equities is for that volatility and for that growth characteristic. So we try not to fade that out too much, but we also try to sort of narrow in that spectrum of returns that we can get from that hedged exposure. So yeah, and I guess the Aussie dollar tends to be associated with risk-on environments, and sometimes it's correlated. Sometimes the global equities exposure is correlated to that, and sometimes it's not. But yeah, and I guess the other thing to note is that we're looking at hedging from a total portfolio level. So if we look at it from a total portfolio level, we do have all of our global bond exposure, and we've got quite significant exposure to global bonds. All of that is fully hedged, and I guess from a hedge ratio perspective, I've got showing on the screen the hedge ratios that we've got. So I guess we're sort of trying to balance all of those things that we've got going on. We've got the growth aspect, the defensive aspect, and the hedging ratio that we're using to try and balance out the risk and return outcomes at a portfolio level.
And it does make a massive difference. I think, Bowen, you did the attribution on this, and I think the Morningstar benchmarks we use don't really have anything to do with Vanguard as such. That's the benchmarks we use. But I think their benchmark was 100% unhedged, and the effect of 30% of hedging across international had what, it was a 1% difference in return. Bowen, was that right?
Over the last 6 to 12 months?
That does make a big difference. So we're hoping the dollar swings back the other way, and we get the outperformance on the upside relative to that benchmark. So
that's right. And over the longer term, I think that's exactly what happens. We've seen the dollar sort of swing from undervalued to quite overvalued. So it is quite noisy in the interim, but over the longer term, it sort of balances out.
Smoother returns.
Yeah,
good.
In closing, and I think this is something that you may have already spoken to your clients about, just having a look at, I guess, the asset allocation approach, and the asset allocation approach that we use at Vanguard is a strategic asset allocation. So although it doesn't vary quarter to quarter, and we're not sort of looking to change lanes per se in those asset classes, it is something the investment strategy group at Vanguard, which numbers more than 60 people, is constantly thinking about. And clearly getting the strategic asset allocation right is critically important for the portfolios that we're running for our clients and for you running for your clients. So there is it's a bit like the swan analogy. There is a lot of work going on underneath the scenes to, I guess, figure out if there's changes that are warranted. Or of course, I've got to take into account the cost of doing that to the end client as well. But something that I think is also important, that if you've got a combination of pretty strong asset allocation and a relatively, attractive fee load, then that sort of can make quite a difference over time. And this just compares some of the lower fee options with the broader universe who tend to change lanes a bit more. And I think over time, I think it's a good combination.
Excellent. Yeah, and I guess to add more context to it, you guys have your asset allocation funds or exchange traded funds, I guess, and the way we approached our portfolio construction was to use that asset allocation, strip it apart, and use the underlying exchange traded funds so we could play with the makeup underneath that, particularly in the Aussie space. So so it's worked well for us and our clients, and we're happy with where it's heading, and the history that Vanguard's got around that performance and the decision-making resources you guys have got behind the scenes there. You talk about the swan. You guys have got, big budgets for these economists to come in and do these reviews. We don't. So we're appreciative of the information you guys provide to us for that work with our clients. So.